Thank you for listening to Mailbox Money, your guided tour through safe, sacred, and speculative investing with a plan and a purpose to do more good with newfound peace of mind. All right, everybody, welcome back to another episode of Mailbox Money. I'm Jackson Wood, joined by my partner, my friend Ryan Kruger today. I think that this episode, this podcast might be the least popular idea that we've ever shared. But once we show you the math, it might very well quickly be the most popular episode that we have created. So I think that you're in store for something special. We are going to go back to the lab today, and we are going to talk about the anatomy of an uncrowded investment, an uncrowded idea, which we believe is a good place to start for anybody, right? You can ask yourself the question, what's one truth that you understand that most people are ignoring? What is one thing that you understand that the world seems to be hating on or ignoring or dismissing? I think you might be finding yourself in a pretty valuable, interesting position if you look at ideas through that lens. You might be standing next to something undervalued, and it might be beneficial to you. So that's kind of the idea of this episode. We're looking at something that pretty much the world hates or dismisses, but that the math actually gets us excited about.
You just have to, the only qualifications as a listener, you have to be super comfortable showing up early at a party. Not a whole lot of other people may even ever attend. Being uninvited to a few dinner parties. And as long as you're comfortable with any of that and can just stick to the math, you are in pretty good spot in the stock market, we have found. Today, the most sustainable dividends, and we were recently asked to share a very unpopular side where the crowd was convinced that energy dividends are not sustainable and most of their businesses are unsustainable. So we were asked, and we've written a lot about, there's some great stuff up on the website. We wanted to talk about it today. I think that the paradox of them being more sustainable because of the crowd's conviction that they're going away will be shocking to some that even believe and they think they know the market, they think they know energy. I was surprised. And the way we got here, as always, was the exact opposite of conviction. I mean, I almost got thrown out of Texas for not owning energy for 10 years. I wasn't at all interested. I'm not an energy guy, no more than I'm a technology guy or a healthcare guy. The math and the best clues for change is dividend growth. Full stop. Of all the metrics that have stood the test of time for 2 centuries, and notice I said dividend growth. Dividends can be a great clue. They can also be misleading. There can be wonderful high-yielding dividends that aren't going anywhere and the company is going under. Dividend growth has to be fueled from rising free cash flow. And if you believe in active management as we do, you can examine there are going to be winners and losers. So this is not about us believing in any sector ever. But those math clues led us to an extraordinarily uncrowded position. And I think we're still early. And we'll even give you some examples, even if you're late, when you have dividend growth right, you want to sit back and enjoy and take a stake. And in our case, an overweight position when you find math this compelling. And in my career, I've never found a more hated sector that also, this is just the objective math here. It leaves no room for opinions, which is my favorite part of dividend growth, including our own. So you have energy as a whole with dividends 1.5 times the S&P 500. They are growing substantially faster, being fueled from more free cash flow being generated by the operating businesses. No predictions, no appreciation, no total returns, just the pure free cash flow metric. And even after this most recent early rally, they are 50% cheaper than the overall market. So the best question about any investment idea like this, how sustainable is it? So one of the metrics we use to measure that is of the free cash flow any company, any sector is generating, what percentage of the free cash flow? Notice I didn't say earnings. That's the more popular metric, the earnings payout ratio. We don't like that. Earnings can be manufactured. There's no accounting tricks for free cash flow. So the percentage of free cash flow payout ratio, which takes a little bit more work, and that's why you got a couple of math nerds here to do it for you, significantly lower free cash flow payout. So more dry powder to increase them significantly more going forward. That's one of the reasons we measure is it sustainable. The bigger issue is kind of like Jackson, your son's food fight in the first week of school. I mean, there is no more confusing disagreement, bigger debate on the future of the industry at all, which unbelievably is actually what is making these dividends the safest. And we want to talk about that a little bit.
Yeah, well, that's a paradox if I've ever heard one. I think just kind of understanding what you're saying here, the companies that we're talking about are paying a dividend 1.5 times higher than the rest of the market. So the rest of the S&P 500, they're growing faster, more free cash flow is generated, and they're cheaper, right? And so that is pretty much a textbook definition of an uncrowded investment idea. But I think one thing that you said is worth noting. This is not based on opinion. All of this boils down to math. And the math, something you said at the very beginning, didn't own energy for 10 years. That wasn't simply because of anything other than the math, didn't compel us to own it. And then when that changes, and as you can see that change through the research and through the analysis, all of a sudden it starts popping up as something you might want to look at, just like the food fight on the first day. My kid threw a carton of chocolate milk after the bigger kids started a food fight and came home, looked like he walked through a dairy farm covered in milk, but he wasn't the perpetrator. So, we let it slide a little bit after we talked to the teacher. But anyways, I thought that was a kind of an interesting paradox and something as a good starting point to look at for analyzing the beginnings of an uncrowded investment
Well,
idea.
the fight on Wall Street is unlike anything I've witnessed, and it's part of the setup of what got us here. Again, we didn't set out looking for, believing in, or wanting to own energy, no different than any other sector. But one of the silliest notions of some of these climate protests, and by the way, we have a whole lot of kids and a whole lot of friends that are younger than us. We want the cleanest future, and we're going to share with you in just a minute what we think the most surprising dividend for the climate can be from traditional energy. So please make no mistake about that. But to set up rules and protests that fly in the face of capitalism, which their biggest reward is solving problems. So let's let that happen, and you might be surprised once again, and we'll talk about that. But these protests forcing institutions to sell shares added to this math. I haven't seen that before in any sector, where everybody would know if a crowd is blindly buying things that doesn't make sense, you're supposed to avoid those bubbles. What if just the opposite is happening? Shouldn't you pay attention to those? What would be the opposite of bubble? I don't know, but like a gigantic hole in the ground that is just screaming for us to dive down into in a rabbit hole. And we're going to talk about the original patent for the first drilling that was able to cut through rock here in a second. The forced selling, relentless selling was, and a lot of people can have their opinions. I'm not changing those. I'm just sticking to the math. But the silliest notion about that was that was going to change an energy company's ability to access capital. They've never had problems lighting money on fire and bankrupting themselves. Access to capital is not the issue. And in fact, it's the lessons learned and the reason we didn't own them for over a decade. The shale revolution right down here in Texas, incredible technology, awful math. They were terrible projects. No free cash flow, not sustainable, enormous debt, issuing shares. the exact opposite of what's going on now. So some of those lessons learned actually planted the seeds to some more conservative math and a devotion to returning capital to stakeholders now. Um, that was that was just a misfire by that protest. That's what would change behaviors, energy companies. That didn't happen. It's not going to happen. Um, the fact, whether you like it or not, that traditional energy is going to be used for the next several decades, and we need to have this dialogue in this country, which we're not very good at having anymore. That our decreasing ability there is actually what's leading to increased dividends in energy. We're going to need traditional energy to get us to better energy solutions that will be cleaner burning. And the United States is so far ahead of the pack, we should be leaning into our advantage there for the rest of the world. But along the way, the votes were clear. Institutions were forced to sell, in some cases, all of their energy holdings. Companies had new regulations, new rules, all sorts of increased permits and years of delays for canceled projects. So as a result, just as a couple of simple bullet points, you've had since 2008 a 90% decline in natural gas drilling rigs. So what did we think was going to happen to the price? And you've had 129 refineries. In 1982, there were 250. We need it as much and more than ever, and we're making, finding, producing, and transporting less of it than ever, setting up an unbelievable opportunity. As a result of all those lessons learned and the free cash flow generated, because it's piling up, they're not able to add to capacity. They're not drilling more. They're not building new infrastructure. They're actually shrinking it. Companies had no choice. They had to do something with the free cash flow. So in comes mailbox money detectives. And you and I start looking at, wait a minute, all of a sudden, some of their debt was literally erased. Now, pristine balance sheets. In some cases, we're not talking about the whole group, and that's why we believe in homework and active management. Free cash flow enabling them to buy back incredibly cheap shares, not issue new ones. So decreasing share count across the same free cash flow, good for stakeholders. And then, as I said it earlier, the biggest clue of all, what we get most excited about, that throws all these words and opinions out the window, if a stakeholder is getting a pay raise every year, and in some cases multiple times per year, they're also returning that free cash flow. They had to do something with it. So be careful what you ask for. They've made energy dividends more sustainable, the exact opposite of what the crowd anticipated.
I think that that's such an interesting thing to look at because we've seen that exactly what happened in the sector play out over the last couple of years with certain stocks gaining popularity, on social media or whatever, and going through like this astronomical or exponential increase in the price based off of nothing other than people just simply buying the shares. There's all kinds of news articles about these companies. This happening in reverse, institutions being forced. And when we say institutions, we're talking like the biggest institutions, Wall Street, forced to sell these shares based on nothing other than political pressure. And there's no math. And I want to make something clear. If we ever sell an investment, it's simply because the math favored something else, right? Or didn't just the math resulted in, hey, this isn't something you want to own for the foreseeable future. Dividend growth rates going down, whatever. There was no math, no financial metric that indicated, hey, we've got to get out of the sector for these big institutions. And that simple irony is what made these companies even more attractive. And that to me is kind of the essence of active management. It's being able to find the sectors that this is happening in, regardless of what part of the economy it comes from. It may be energy, it might not. Who knows? It hasn't been for 10 years, and now it's finally starting to kind of show up in the screens, and the math looks really attractive. I pulled up a chart, compared the energy market to the broad U.S. market and then the global market. And when you go back, to 1998, there were some periods of underperformance. You can even be late to the party and still enjoy enjoy the return. So just this year, energy stocks are up 80% in a pretty difficult year for the US market and even worse for the world market. But the price to free cash flow ratio is down 40%. So the performance is increasing in terms of the share price, but they're getting cheaper by valuation. And to me, that's an incredible position where you don't have to worry about, am I late to the party? Did I miss it? Uh, the math is still there and still showing
I
up.
think that point can't be underlined enough. I'd rewind and listen to that again, and be a little barroom trivia as you try to impress your friends, like I do, which is why I don't go to bars and talk about math. But the ability for a stock or a sector or anything, the price to increase 80%, and Jackson said the valuation got cheaper. That's what happens when the free cash flow was rising even faster than the rally in shares. And that can only happen if the crowd is either ignoring it or even better, and this is what I get real excited about, completely disagreeing with it and letting their opinions and ideas get in front of the math. And to give you an example of how uncrowded this idea was when we started to establish our position, which has continued to grow. And Jackson, you said something earlier. I mean, sell disciplines would take us out of this in the blink of an eye. This is not about conviction. It's about curiosity. We don't dig our heels in on anything. We could hit sell disciplines while we're recording this right now, and it would not change. We have long ago put any ego aside and are devoted to the math of returning free cash flow in the form of dividends to stakeholders, and that's all that matters from wherever it comes from. But to give you an idea of how uncrowded this was before we established our overweight position, and it's not hard for you to do the same because the entire energy sector is about 2% of the market that everybody's wondering, is it overvalued, undervalued? Where is it going? 2%. Now it's doubled in this huge rally. 4%, you think we're early or not? 4% of the market out of all the companies in energy. And yet, 8% and growing faster of the market's free cash flow is energy. One of your favorite charts that we worked on together, I mean, this is the Picasso, frankly, of nerd math. Okay, maybe you can post in the link. I don't know how to do fancy stuff like that, but to show you how uncrowded it was. And I'm not a fancy car guy. I got nothing against Teslas. I think they're great. But recently, you could buy every single energy company for the same $1 trillion that it would cost to own Tesla. And that's the market. You have a choice. Which one? Every single energy company or Tesla. And then right below this Picasso that Wood will put up, what about the revenues and the free cash flow compared? And we'll put that up. I'll leave that there. You can feast your eyes. All my opinions out this window. That is uncrowded. That is math. I get excited, and before I get too excited about what I think the most surprising dividend will be and what people are least expecting will happen next. For anybody wondering, is it too late? And again, if you want to learn more about what we're doing about it, we have it up on the website. We'll continue to share. No different than any other sector. This just happens to be the most compelling math I've found in a long time. And we're establishing positions still in private individual accounts. This is not about where and how. We also have an ETF. We cannot mention it by name for compliance reasons, but we are, full disclosure, as always, Jackson and I are talking about our own personal accounts. We have an overweight position in energy. Is it too late? For a lot of reasons we just shared, I don't think so. But to give you an idea of the conservative math and the kind of companies that we particularly want, because we don't want to own the group any more than we want to own any group. We believe in a very, very concentrated portfolio. The math recently shared by a guy who's been a CEO for 40 years, who says this is the best situation he's ever been in for free cash flow. Their dividends, full transparency, that's the other thing I like about dividends. Nothing to hide, they can't lie. They're being calculated, no projection, no what if, on a floor of $40 crude oil and $2.50 natural gas. Depending on when you're listening to this, It's double, triple, or quadruple that in the free market right now. Not a prediction, not a commodity trader. Let's just say it's significantly north of 40 and 250 for a lot of constricted reasons that are not about to change, and we're not about to not need traditional energy. And I think some people get lost in energy and gasoline and where they see and know energy is, but it's in every single thing you're sitting or standing around or listening to or walking with right now. I mean, it is 99% of even the healthcare products that we talked about a few episodes ago. Petrochemical use is in every single thing we touch. The idea of putting traditional energy out of business, which some people ran for office on, was so ludicrous and short-sighted and just didn't deal with the facts and the math. And then when some of those same folks then have to write letters to pretty please to the energy companies to make more, you might be on the path to some very tight supplies if it can change that fast. Um, I just wanted to share some of that conservative math of where it's coming from and some of the raises that I think are more than sustainable.
You may not have to take your Tesla to the gas pump, but when you plug it in at night and pull electricity from your home, it probably comes from a power plant powered by natural gas, unless you have the Tesla solar roof. My first job was working at a power company. And, anyways, I just thought that that would be kind of a fun little idea to look at. But there's one point that I do want to make. So if you think about using your math or the math at, dividends in the energy sector are covered at $40 per barrel oil and $2.50 natural gas. If you think about taking another step back, taking income out of your portfolio, if you are basing your investment in your cash flow on the idea that you're going to be receiving dividends from free cash flow from company, you don't have to worry about a 4% rule depending on the market S&P returning its long-term average of 10%. So I know that that's a bit of a jump, but I think that that's important to discuss because I've talked about this in previous episodes. What you own inside of your portfolio can generate from free cash flow dividends to cover your expenses. And that's the entire point of this is understanding the income that your portfolio is generating, where that is coming from, and not having to rely on a market that should do something based on interest rates doing this or whatever the other methods of financial planning for distributions are. I don't even like using the word distribution because that could be a little deceiving in terms of like, oh, I'm getting a yield on this. No, a distribution can be selling down the principal and maybe some dividends. We're talking dividends from free cash flow of companies. And then when you take a microscope to those dividends, are they safe? Are they protected? The math says yes.
I'm so glad you made that point because, as we often said, this should never be about what we like. It should be about what stakeholders need. And that's what you can build a plan around, not somebody's theme or idea or prediction. And I will give a mailbox money hat to any truthful comment because I would love to meet somebody who drives a Tesla and overweight traditional energy. Um, you can like that unbelievable cool technology, but your spouse or your family might really benefit from yield on cost and double digits and rising. And mailbox money hat for, and I guess how would they do little proof somehow, Jackson? I'll let you be the sleuth and to verify. Send to you as my gift. I want to share my only prediction that we won't put a nickel in investment behind because we're going to stick completely to the math. But what would surprise the most number of people on any side of this debate, with a very few exceptions, and I happened to talk to one recently, they were much more excited to talk to me about some new clean energy alternative sources, incredible improvement for the climate, technology, that brand new technology than they were about the traditional energy, dividends, free cash flow, and all of this for years to come that we just talked about. It might surprise someone to know that it's the same company. So, what I think would surprise most people would be, and I've just wondered, who better to solve our dirtiest problems than the ones who have the blueprints of the problems to begin with. So I'm not going to be shocked at all if, and I looked, we celebrated, I guess we have different kind of parties around here than most. It was the 1909 anniversary for Howard Hughes' patent for the first drill bit that cut through rock. It was a one man party. Um, I will not be surprised at all if some of the next patents come from those traditional energy companies who are just as interested, not to do good things for political reasons, but to make money. And capitalism will reward problem solvers. They also have kids and grandkids. They know we have an enormous technology advantage in this country. I'm not going to be surprised if it comes from some of the traditional energy companies. And I couldn't help but notice, so I had to put their picture up there, because I presume and I hope none of my kids are going to Harvard. So I'm gonna just make it real clear. If there's any admissions officers listening to this, I'm gonna remove that doubt once and all for all. The protest that led to their endowment, and a lot of people like to follow the smart money. So after Harvard, a lot of others eliminated energy from their portfolios. I'm just the kind that wonders, are eventually those protesters, they do want to return to their dorms, presumably with some HVAC and at some point a warm shower. I could not help but notice, so I took my detective work around the corner. We've got this picture on the website, freedomdaysolutions.com, the most unpopular idea you will ever come across. That's the podcast we're delivering to you today. There is a power plant that they just finished on the same campus for these kids with unbelievable new clean technology, winning awards for better climate, burning natural gas. I don't disagree with any of those protesters. And I want to make a lot of money for our stakeholders while they sleep. And I don't ever want to be a part of a crowd or a protest. I'm going to just stick to the math.
I absolutely love it. To learn more and to read an incredible article that Ryan wrote that got featured on all kinds of financial institutions, you can visit our website, freedomdaysolutions.com/blog. And as always, you can send us an email, team@freedomdaysolutions.com. It goes right to Ryan and I. And with that, we'll see you next week.
This show is brought to you by Freedom Day Solutions, LLC, a registered investment advisory firm advising individuals and families nationwide. Performance is not guaranteed, and past results are not necessarily indicative of future performance. To learn more, visit freedomdaysolutions.com. This show contains general information that is not suitable for everyone and was shared for informational purposes only. Any forward-looking statement or opinion expressed is subject to change without notice. Nothing contained herein constitutes investment, legal, tax, or other advice, nor is it to be relied on in making investment or other decisions. Clients of Freedom Day Solutions may hold positions in the securities discussed.